TheoTrade. This is Don Kaufman. September 28th, 2022, just moments before the cash close here on this Wednesday afternoon in the midst of an absolutely rip-roaring rally. The S&Ps are up some 80 handles, but that just doesn't do it justice. We are off the 36.13 level. In overnight trade, we actually breached into new lows. Out of nowhere, the Bank of England comes out and does what? Supports their bonds. Are central bankers starting to panic? That much more here covered on this evening's video. First, let's take a detailed look at some of the trade action today. I mean, it's basically been an up trading session, not without its issues, however. Again, we touched down in the overnight trade. I mean, we saw over 700,000 S&P contracts trade before the cash open. Take a look at the overall volume inside of the S&P futures here, which right now, they're faltering here a little bit, but we're doing about 2.5 million contracts. For those of you that do not speak complete and utter geek, 2.5 million contracts, all right, starting to get it done. I mean, this is the kind of size that you look for in capitulation inside of markets, and we're starting to get there. We're not home yet, but we're starting to get there. All right, let's get down to business here. As I was saying, for the most part, it's been a rather up trading session, not without, though, a couple of little glitches here. This morning, Apple had actually come out with some news, effectively Apple reducing the number of iPhone 14s, or if you will, not going into heavier production. That was a huge drag, expressly on the Nasdaq this morning. Even though the Nasdaq came out, relatively strong versus Apple, and the Nasdaq was basically flat during the course of this trading session, finally kind of lifted off and actually dragged Apple a little bit higher with it. Highly unusual to see that because, again, the news in Apple quite dire. Nevertheless, outside of all of that, again, everything is completely and totally correlated. Once again, that reeks of volatility. And one of the things that I can't express, okay, at a greater time than this, in the midst of volatility, you are going to have the quintessential rip your face off rally. And this has all the hallmarks of just that. So before I talk about Bank of England and any of the central bankers, look down the tape. There's the closing bell. By the way, not a second too late. S&P's backed off 10 handles into the cash close. All right, look down the list some of the usual suspects in the marketplace. Does anything seem striking? One of the first things I looked at here today, so you're seeing a 2% rally in the marketplace. Did volatility back off? Yes. Not that much. I mean, again, you got a rip-roaring rally in the marketplace, the first rally that we've really seen. Sure, VIX actually came in. Sure, volatility futures came in nominally, but they came in. The one aspect, though, that really resonates in here, we're still in a pretty strong backwardation. Effectively, what I'm saying is that front vol, like AAPL vol, is trading closer to 30. If you look at some of the back month vol, 29, so we are still, again, in a fairly strong backwardation in terms of the volatility futures. At this point, that unto itself, I don't even need to go any further than the S&Ps and the vol futures to say you're definitely not going to sound the all clear. Now, that doesn't mean that if we continue to rally up in the next few days, the volatility futures can come out of their backwardation. We can actually say, all right, all clear. But at this point in time, hey, unfortunately, with this backwardation over here, and it's pretty sizable backwardation we're still in, can't sound the all clear. Okay, let's get down to business now. Let's take a look at the bond market. The bond market, staggering rally back. But lo and behold, I mean, people, you haven't really had much of an up day anywhere to be found since, roughly speaking, the beginning of August. From August, to present time, what are we seeing? Just hideous and unrelenting sell-side activity inside of the bond market. I mean, if you're kind of curious, like, what does a crash look like? This is what a crash looks like, And this, nice, large green candle, I just wish that it was natural. And when I say I wish it was natural, you do realize that the bond market, was down and down considerably before the Bank of England came out and did what? rescued the marketplace. Now, let's talk about, okay, Bank of England for just a second and what they ultimately did. They went out there and they bought their bond market. So they went into the open marketplace and influenced it by buying bonds. By any other name, I would think that that would be construed as quantitative easing. Isn't quantitative easing over? Aren't we doing quantitative tightening? In fact, didn't the Bank of England just recently kick off their version of quantitative tightening? The answer is absolutely did. So with one hand, we have them tightening. With the other hand, they have them loosening. You guys figure that one out. It's called panic, people. Okay. And the big question over here, are central bankers starting to panic? Well, it's pretty evident that one of them already broke. And on bended knee, okay, they're begging the marketplace, please stop selling the bonds. And I'm going to tell you right now, Bank of England appears that they're going to do anything possible, anything plausible to not allow their bond market to continue to sell off. Along with that, you better believe they're going to start to support the British pound. The question is, at this point, is it going to work? Is it going to hold? If you take a look at like a 30-day 1 hour, okay, there was actually a flash crash inside of the British pound before it recovered. Obviously, the British pound doing a little bit better today. But of course, okay, of course it's going to do better today. They turned around and actually started throwing capital inside of their bond marketplace to stop, if you will, again, the crash of the bonds. Now, a crash in bonds, what does a crash in bonds really do? Well, if you take a look at the TNX, a crash in bonds would take interest rates considerably higher. One of the things I'd love pointing out over here, you do realize that in overnight trade, our bonds were crashing as well. In fact, the 10-year actually clipped right up to 4% before backing off to basically 3.7%. You got to recognize that the kind of move that we've seen over here, we're just looking back just a few days, we're at 3% and we went to 4%. Okay, these are unheard of, unrelenting moves inside of the bond market. So the Bank of England comes out today, ultimately is the first to, if you will, cave. And that's exactly what happened. They caved in, they couldn't take the pressure anymore, and they caved. And ultimately, what do we have? A version, and the first version, if you will, of quantitative easing in the midst of quantitative tightening. I think that what the Bank of England actually did is really reminiscent of where Japan's at right now. They painted themselves into a wonderful liquidity corner. They have not figured out how to get out of it. The only problem is if inflation continues to run hot, what do? With one hand, we'll do quantitative tightening, but don't worry, we'll ease on the other hand until, again, something continues to break. Well, obviously, something did break. The Bank of England broke. Okay, continuing on over here, the one aspect and what should really resonate with you, I would not anticipate this, okay, to be the path that the US and the Fed is likely to take. Take a look at the rebound again inside of the bond product. I reiterate, our bonds this morning, in fact, let's go to a 30-day 1 hour. Our bonds were down dramatically this morning, and they actually ripped higher along with the move from the Bank of England. In fact, if you take a look in the overnight trade, our bonds actually were down into the 123 handle before actually closing all the way at 127. These ranges are not just phenomenal. We're talking about, once every couple of years, you're ever going to see a move this significant inside of any bond market. I mean, how often do we talk about, again, the TNX having a range from roughly 3.7 from coming off like that 4% inside of the same 24-hour period is unheard of. All right, so with this in mind, you're looking at the markets right now. And again, not everybody necessarily is a bond geek, and I get it. But I think that's the trade that you have to be concerned about. Obviously, you're going to be concerned about the currency trade as well. So what? It's the first down day inside of the dollar. It doesn't mean the dollar can't turn around and spike up to 120. Okay, but you did have a central bank intervention today, and that's kind of what the marketplace, I think was kind of anticipating to some degree. Are they going to get more of it? Well, listen, Bank of England is now in a position they're going to have to do anything and everything they possibly can, but that's one sovereignty. Are there going to be other banks that are going to start to actually roll over? In the very near term, I would assume not. They're going to try to hold off as much as they possibly can because on one hand, you've actually got the bond markets and the currency markets that are just annihilating these economies. There's no other way to put it. They're just annihilating the economies. You have not felt the effects of that, okay, on Main Street. On the other hand, over here, you have inflation that is annihilating these economies. Where are you going to go with this? Okay, and the central bankers, well, they're just simply caught in between, and you're starting to see this incredible kind of catch-22. One by one, though, eventually the central bankers, they're going to have to roll over. They're going to have to pivot. In the meantime, that volatility is not going away. The volatility is not going away, and I'm actually going to throw out even a bigger discussion over here. Okay, we could actually sustain a few days rally. There's no problem with that. In fact, I'm the first one to say, hey, maybe we should have a couple of days rally. Okay. Nevertheless, you got to be a little bit nervous, and you have to be nervous because even in today's cash close, you hit this 37.50 and we pulled back like we just touched something that was horrendous. Okay. But my concern at this point is if these central bankers, even if they do start to pivot, they're starting to lose any semblance of effectiveness. Okay, and the marketplace can actually start to turn on some of the central bankers. That's something I'm going to be discussing significantly more in the near future. That, hey, okay, you can't just have Bank of England turn around and say, that's it, we're going to support our markets when all the other markets are actually tightening, right? Because eventually it's going to break the back of Bank of England. So is, for instance, what, the ECB, that's the European Central Bank, are they actually going to turn around again? We're not even close to that point in time. Pressure is still on in this marketplace. Do not forget it. I think you're actually going to see a retracement of the bonds. Okay, after a few days to the upside, you very well might get a retracement into new lows in the bonds. Listen, people, a statement's being made over here. The marketplace is effectively saying, we hear you, central bank, and they're just taking it right now, okay, down. If the central bank is going to pivot, the interesting thing is situation is going to come to a head, possibly not here towards the end of September, but by mid-October, if we can see continued sell-side activity in this bond market, in the U.S. bond market, it may actually break the back of the U.S. Fed. And again, okay, any recognition, if you will, or a semblance of, as I said, credibility could be lost in central bankers. It is a huge phase that we're actually entering into right now of quantitative tightening and easing at the exact same time. I think you should expect that we're going to see considerably more volatility for the remainder of the week. I've said this throughout the course of this entire week here at TheoTrade. These are the kind of nights where check the futures in the middle of the night. Why? Look, this trading week was expecting $123 of movement. That's $123 higher or lower. Again, $123 higher, $123 lower. Even with today's rip-roaring rally, you know what the S&Ps are doing? Right now, for the most part, they're massively unchanged from the week. Again, just to give you a little bit of a feel, you see the rip and rally over here. Where did the week even start? The week started roughly in the SPX, okay, at 36, we'll call it 94. Where are we trading right now? 37, 19? So what do you got? You're 30, not even 30 handles off of where we started the week. Are we actually up on the day? Of course we are. Again, it was a rip your face off rally, but volatility still points to more risk. Bonds, come on, people, they're a hop, skip, and a jump from actually causing the S&Ps to spiral out of control. Look for some heavy vol this Thursday, Friday, really heavy, $123 move, and we've got nowhere near the upper end or lower edge of the expected move. So, hey, okay, main story here, keep your helmet on. If rocking underneath your desk back and forth helps you, do what you can. They're going to tell you right now, volatility is still very much with us. Okay, expect more throughout the course of this week. And again, this bid in the marketplace might sustain itself. If it does, it's going to create a wonderful short opportunity here in the very near term. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.